Did you get a sense of the technical expectations? Oh, it was awesome. Great. All right. Now that's good. So I'll want to then firstly, as we go, to then just unpack the technical and then dive deep into the scenario to see how we were then expected to deal with this. So in IS2 or FS2, sorry. So I told you that you need to come having prepared to say if it was an equity settled scheme, how will you handle it? If it was a cash settled scheme, how will you handle it? And if it was a group scheme, how will you handle it? So one of the things that we then needed to do is to then to go and understand where do we sit. So one of the important things as well will have then been determining the balance at the end of the year. And we mentioned that there are a couple of components in determining the balance at the end of the year. And at this point, it doesn't matter whether it's an equity or a cash settled scheme. We then said that we have what? We have the fair value. And we said that the fair value takes into a number of conditions. And we then said there are some are vesting, others that are non-vesting, and others that are post-vesting. So now let's talk about this so that we are aligned in terms of which one is which, so that when we get into the technical or into the detail, we are clear that when they say that this is expected from the teachers, that this will be a vesting condition. When they say that this is expected, we know that it's a non-vesting condition. Can someone just clarify the difference of the three conditions for us? When we say it's a vesting condition, what do we mean? Can someone just clarify for us? When I say it's a vesting condition, what do I mean?
Hi, Renan.
Good evening.
I think these are the conditions that has to be met before the beneficiaries, they receive them, whether it's shares or cash.
These are the conditions that have to be met, you see. So are you suggesting that the other ones don't have to be met? Dimakatso, are you suggesting that?
Not really.
So if you go with, who is going? With Ryan into this board meeting, and one of the board members says that, I see you guys are talking about this vesting condition. What are they? How will you respond to that board member? How will you respond? So the board member is saying that, I see you are telling me that the accounting for this will depend on this vesting condition. What is a vesting condition? Please tell me about this. What is it?
Uh, can you hear me?
100%.
Yeah. Yeah, it's been a long time we did this, but what I remember vesting conditions is like there must be there must normally it's either there's a performance condition or it can be a service condition, which is usually like say they must complete 3 years. They must remain in employment, say for 3 years or 5 years, and then after that, then um, the shares will vest after the completion. So that's where there is a vesting condition. And the other side is where there are like conditions to say maybe if the shares, maybe if the what do you call that might apply to directors to say if they manage to maintain a certain profit ratio, or I don't know, then if they manage to maintain that maybe for at a point in time, then there will be the shares will vest at that point in time. That's what I remember, but I don't know if I'm correct.
All right, thank you very much for that. But it sounds like you're giving me an example of a vesting condition. So as a board member, I'll say that I'm still not clear which then falls under that universe of yours. Because you're giving me examples of vesting conditions and they are all correct. But if now there is, then when we are reading here, there is a condition. As a board member, how am I supposed to know that this right here will be a vesting condition? This will not be a vesting condition. So just give me a sense of the difference here. Because I am with you with the examples and you're absolutely right. But you've just given me an example. And I am still having this question mark that as if I say that the teachers need to ensure that there's 100% pass rates in matric, is that a vesting condition? Why is that not a non-vesting condition? Why is that not a post-vesting condition? So what is it? What makes a condition a vesting condition? How will someone know? Okay, I see Atara, please go for it. Let me see the comment.
Hi, Randani. I'm reading what it is.
Which I wanted you to read before. Are you reading just now?
I'm reading now. I'm going to read for us. A vesting condition is a condition that is directly aligned to the service being provided by the employee. For example, if we're dealing with teachers, a teacher must remain in the employ of the company for 5 years. That would be an example of a vesting condition. And then a condition, it's also a condition that determines whether the entity receives the services that entitles the counterparty to receive cash or other assets or equity instruments of the entity under the share-based agreement.
Yes. So, yeah. Go.
Yeah. So there has to be the employee that's entitled to the employee incentive must have performed services. They must have given must have been in the employ, i.e. they must have provided services in order to be entitled to that. So it's a condition. You must do the service, then you get your employee share scheme benefit. And then a vesting condition can be a service condition or a performance condition. Service condition example would be you must remain in the employee of Archegos for 5 years. And then performance conditions is split into the following. market conditions, non-market conditions, and non-vesting conditions. Must I go on?
But hold there. So let's just catch up. But essentially, that's what you need to pick up. That if then a board member asks you in simple words, is that this is a condition that will ensure that we receive something from the counterparty.
Yes.
Because if we then say that you as teachers, you should be committed, you should not go and post anything about the school on social media. So that is a condition, but it is not a vesting condition because we are not receiving any services. We have just given a limitation on what you can do. And as a result, it will fall under a non-vesting condition. If we say that you're going to be working for any of our school, but you cannot, during your employment, be offering private classes to the candidates, be offering any services to other schools, that's a non-vesting condition. Because you fulfilling that condition does not result in us receiving a service. Yeah. So that is the difference here. So that means when you're going in, you needed to have prepared to tackle whatever conditions that they were going to put as part of this scheme, so that you can therefore understand whether this is a vesting condition or a non-vesting condition. And a post-vesting condition, as the name suggests, the employee has fulfilled, they've provided the service, and we are now imposing a restriction after the shares has vested or the equity instruments have vested, to say that you cannot sell to teachers outside the school. You cannot sell it to so on and so on. When you leave, you have to sell it back to the company. So those kind of conditions, they're imposed once the scheme has vested, and that's what we call vesting condition. So it means that you needed to have that understanding because they have an impact on the accounting. So we are saying these vesting services are received by the entity in exchange. Those services are received by the entity. For example, no working, no charging for private lessons to registered candidates. And here, for example, staying in an organization or in the entity for a certain. And then post-vesting restrictions imposed after vested. For example, no sale to non-employees. That is what we needed to pick up, because I would have expected that in this scheme, they're going to be introducing a couple of things. So I needed to be ready to handle this. Okay. Then the next thing that one will then need to clarify is that what is the impact of the vesting conditions on the fair value? On the fair value of the equity instruments granted. How do we deal with the vesting conditions? Do we include them? Do we not include them? And so, what do you think? What do you think? In determining the fair value, do we include or exclude the vesting conditions, non-vesting condition, and so on? What did your research tell you?
Hi, and then I'm not answering for now what you are asking. I just wanted to confirm something. The post-vesting conditions, are they the non-vesting conditions? Or what are,
So non-vesting is separate.
okay. And then where are the non-market conditions on your list?
They are part of vesting because they are called market vesting condition or non-market vesting condition. That's their full name.
They fall under the umbrella of market conditions.
No. So maybe to then clarify, under vesting, how do I? Why is that now? So to clarify here, we have a service and a performance condition. And under a performance condition, we then have further market. We have market and non-market condition. Makes sense.
So where are the post-vesting conditions? What they fall under? Because I don't have that term in my research.
You don't have it in your research?
Yes, and I want to have it, but I need to know where it comes from.
It comes from, I think there was a post right here. And it was in that, what do you call it? It was also in the pre-release. Wait, all right, I'll find it, but yeah, we'll pick it up.
All right, no.
Yes, yeah, we'll pick it up. We'll pick it up. I remember seeing it. But yeah, but the post-vesting condition, I'll also share the paragraph. So paragraph 23, yes. So paragraph 23, so the standard refers to as after the vesting.
Thanks, Randan.
Cool. And then non-vesting, that's paragraph 21A. And then the vesting, that's 19 to 21. Okay. So wait. Yes, so now in relation to this paragraph that I've mentioned, how do you then incorporate these conditions in estimating the fair value of the equity instruments granted? How do you incorporate it? How do you incorporate it? Do you take them into account in estimating the fair value, or do you ignore them?
Renani, I think the first one, the vesting one, it does not take into account the market conditions, if I remember correct.
The what?
When you're determining the fair value under vesting, I think it does not take into account the market conditions. I don't know, you correct me if I'm not right.
So let me just make sure I'm hearing you. So in estimating the fair value and their vesting conditions, what are you saying? Do I include or consider those vesting conditions in finalizing the fair value amount? Yes or no?
Yes, but you do not look, you do not take into account the market conditions.
So you are saying that I take into account the service and I take into account the non-market, but I ignore the market condition. Is that, am I hearing you right?
Yes, I think so.
All right.
If I remember correct.
All right, but what is your research telling you? Do you not have it with you there?
No, I don't.
Okay. So I see my judge.
And maybe just to clarify to
Oh.
that speaker, I think it's vice versa. When you determine the fair value, you take into account the service and performance, but which are market condition. The one that you don't take into account when determining the fair value is the non-market condition.
I agree. So in determining the fair value, the market vesting condition are considered. The service and non-market condition are not considered. Yes. As vice versa true, the response given. Clear. Because while I was doing my research, I was concerned that what if they had done, remember that one of the tasks we're expecting is that they will have calculated the share-based payments and will then be required to analyze. So I will have come into this assessment having prepared to say that what if I then see them giving me fair values and say it has been adjusted for this and that and this. I need to say, no, Ryan, you should not have included 1, 2, 3. So I needed to be on top of these technical issues. What about the vesting conditions? Do we take them into account in estimating the fair value of the equity instruments granted? Do we? Do we?
Yes, we do.
How do you know? Talk to us.
As per paragraph 21A, it specifically says that an entity shall take into account all non-vesting conditions when estimating its fair value.
100%. So the standard is clear there. So these are taken into account. And the post-vesting conditions, these are also taken into account, but where is that clarity? But let's just note it for now. I'll just find the clarity. These are taken into account as well. So you've got this. And you are now saying that I'm going into this assessment. This should be part of my toolbox. I should not be caught off guard by the psychi examiners without having the right technical knowledge. So I would have needed, comfort around these things because I was convinced that the task will be, yes, a scheme, evaluate it. But now let's go and then we'll pick up some of the issues. But as I was saying, that these were some of the core things. So remember, I told you a while ago about a proposed incentive scheme for the employees that Denise suggested. Well, we came up with a rough proposal that we want to pitch to the rest of the board. And that's why, for me, it was important for you to be able to simplify some of these things when talking to the board. I will need your assistance in drafting a PowerPoint presentation. That's good. At least a PowerPoint presentation, it's crisp to the point. that I can present at the next board meeting. The proposal is that we identify our top teachers based on experience and the value that they add to the business. This can include both existing and new teachers, but any teacher will only be eligible to start participating in the incentive scheme once they have served with the company for an uninterrupted period of 3 years. So they are saying to us that we will identify our top teachers. So the scheme is for the top teachers. And you'll remember that we were also wondering that what is going to happen to the existing scheme? So that question is still not been resolved. We are seeing the top teachers being identified, and we are seeing that this will then be new and existing. But then they say that the teachers will need to serve the company at least 3 years before they participate, meaning that you cannot work for the company this year, then leave and come back. But again, I wondered when they say that you are servicing for the uninterrupted period. Have we considered that some of the existing could have then served the company? It could be a teacher that has been with us, say, for 10 years. Will they automatically participate? How did you read this? Can I just hear your views? How did you read this? Did you consider that all teachers are starting from scratch, or then there will be existing teachers that will be a bit ahead? How did you read this?
I only saw the 3 years, Rendani. I didn't interrogate it further.
Okay, but now sitting here, what do you think?
I think it would be fair for those that have been in existence to participate, because I think I would then question if it is fair, if we're saying that everyone should, then we should start counting from, say, now, if we're introducing it. So I would have questioned it, the fairness of that.
So you will have then raised it as part of the key considerations. Okay, fair enough. And your suggestion will be more leaning to say, let's recognize the experience that the others have already provided. Is that your view? Or everybody should be on zero and start afresh?
I think that would be, I don't think it would be fair. I'm just thinking if I've already worked for the company for, say, for instance, more than 10 years, as you're saying, then they introduced this scheme. I don't think it would be fair for me then to just start counting from now. If I've been a top teacher, I mean, I've been performing well, even in the previous years, then perhaps it would be fair to consider backwards.
All right, thank you for your view. I see a couple of hands up. Is it Shanti who's on top? Yes.
Yes. So my thought is that this scheme is being introduced to address the short-term problems that we had. So being unable to meet our cash requirements for the 13th check and the performance bonuses. So if we are now saying that our employees should serve for an uninterrupted period of 3 years, doesn't it disadvantage the people that are currently there right now who would normally qualify for a 13th check and a performance bonus that don't have a 3-year service in their belt? Like,
so you will have raised a concern to management about it disadvantaging those employees.
yeah.
All right, that's fair. That's fair. And again, to your view, maybe before you go, you read it as if everybody's starting from zero.
I'm neither here nor there because
Okay.
yeah.
Okay.
Yeah, it's just another thought. I mean, obviously, it would disadvantage the people that have like maybe 10 years, 15 years, whatsoever, but also the people that would qualify for short-term benefits. and maybe I've been there for a year and now I must wait another 2 years, for me to actually qualify for this scheme that is being introduced while I don't get a bonus at all. So it's just another thought.
And remember that the cash part, remember, it was one of the objectives. If you go back to that pre-release, they had another objective of attracting talent, attracting and retaining talent. Do you remember? Right?
Yes.
So I would then want you to also be conscious of that, to say that, yes, maybe that could help with attracting or not attracting, to comment on that at least, that about the new teachers, they are not expecting that 13 check. Do you think that this will then achieve the attracting of talent? And that's probably one of the things that one will need to do. And as much as this is saving us cash, how do you think that it will then land on the employee side? Do you think it will give them enough incentive for them to stay?
Sure.
Yes. So this was a very, for me, a very loaded statement, because all those questions that we had during the pre-release, they were still hanging there, and therefore I could have then brought that thinking that we explored about, yes, cash, retaining talent, and so on, to say that now that you've clarified for me this part, then this, I don't think it will land well. Then, but let's just finish this paragraph. And it says, after that period, we will grant these individuals phantom shares, synthetic shares in the company and in the parent company, which will be repurchased by A after a vesting period of 4 years. In other words, a further 4 years of what? Of service. So this is a very interesting scheme. So we are saying that, number one, you work for 3 years, you get this synthetic shares, phantom shares, and then these are not cash, these are just phantom shares. And phantom shares, they clarify that these are not actual shares, but they are just like a representative of a share. And then after 4 years, we then buy back those shares from you as the teacher. So that is how the scheme is working. And they have now clarified what? They have now clarified the nature of the scheme, because the nature of the scheme depends on whether it's a cash settled or an equity settled. But now what they have done, did you see that they have introduced a group scheme? And the scheme has got its own rules, right? A group scheme has got its own rules. So maybe before we do, I see a couple of hands. Denise or Dennis? Yes.
Hi. I just want to confirm something, perhaps. So basically, I think where I'm trying to pick up where I went wrong, but basically you were saying it's not only about evaluating, the accounting aspect, but you're also looking to say, from a general perspective, is the teacher in a far better, worse off position or in a better position in terms of the, okay. And then just the last thing, so obviously from what you discussed last time and what you are bringing across to say there is already an issue in terms of the benefit that the teachers are going to get in the new scheme. Is it, if I'm getting you correctly?
Yes, and also if you are reading it the same way as me, to say that it sounded as if all the people started from scratch. But even if you took a different view that no, the others that have been here, they've not started from scratch, then are also going to benefit. Because if you then took that view, do you see some of the complications that appear? To say that, let's say I've worked for 10 years for this school, right? then now it means that if you recognize my previous experience, I have met these 3 years, and I've also met these 4 years. So what is going to happen to me?
I see.
So there was very interesting elements that you could have started raising based on your view of this scheme. That do I now automatically get this? And then you might wonder that this repurchase that's going to happen, is it going to happen each and every year? Because with the 13th check, it's like I knew that each and every year I was going to get this. But now are you now telling me that I'll only benefit once in 7 years' time? Is this now what we've changed the scheme to? Because now it means you've put me at a very worst off position. And yes, I could see your intention of saving cash, and I'll raise it as a positive. But I will then caution Ryan and Denise to say, hold on, you might end up losing key employees if this is what the case of the scheme is. That you will only have this once-off payment where there's a repurchase and the employees don't get a bit more. So when we analyze this introduction, we actually had more concerns, and it was not impressive in itself when we kicked off. Do you see that?
Yes, no, it makes it clear. It does makes it clear. Thank you.
All right, cool. And then Atara.
Hi, Rendani.
Hi.
I think you've answered part of the question I had, but now my view was that we are trying to attract top achievers, new teachers, and also we're trying to retain this existing teachers. So for me, I understood that there were other teachers that would be ahead, and there were other teachers that would obviously be new, but I liked this scheme because it accommodated both the existing and the new teachers. So the existing teachers then had sort of a motivation to stay longer, and the new teachers obviously didn't feel excluded. So it sort of had a balance in my view.
Yeah. And those are good points, interesting points, yeah.
Yeah, and the other thing was Archigos is going through financial difficulties. So at this point, they are not able to make payments. So to motivate the existing employees to stay a further 3 years, and then to encourage the new employees to stay for 3 years minimum, made sense for me, in that we are hitting two birds with one stone, because we are able to buy time before we make payment, and we're also able to please the new teachers. So I in my opinion, I didn't find this negative at all.
Okay. All right. So you were with Ryan and Denise. You were in that team.
For a change, I was there with them.
So
sorry, Rendani.
Yes.
I don't know. Am I reading this wrong? Because I see 7 years.
Yes. I also see 7
so
years.
People have to wait for 7 years until they get their bonuses.
Imagine. Yeah, that's yeah. So that's where
is that not is it not the new ones that have to wait 7 years, because the existing ones would have met the 3 years at Shegos or Akegos?
Yes.
It's 7 years for the new ones, but the existing ones is just the 4 years.
Yes, but that means
how?
No one's gonna be able to sign the contract and say, yes, I want to work there, because they know that they're gonna wait for 7 years. So they're not gonna get any new teachers, because this is not attractive.
You did tell the examiners about that, right? Because I think these are some of the things that when you say potential benefits and downside of the proposed scheme, I will have then expected to be coming up. So the downside is that it might be difficult, as you put it, to attract new teachers because you're expecting them to wait 7 years to start benefiting. And I mean, this is a top teacher that you've identified. I mean, I'm doing well where I am, and you're calling me to come and wait 7 years in your company. Will I go for it? Because you're saying I'm a top teacher. Do you understand?
Yeah. Well, Brenda, another problem that I had here was the experience. Because there are some teachers that come right from school and be very good at their jobs. They don't have the experience. They are much better than the old ones that have been here for 10 years, because the ones that have been here for 10 years, they are like tired. They don't have the effective ways of doing things, you know. So I think that was my other problem, the experience part.
Yes, it was quite an interesting one, because I also said, what is the definition of value that you're talking about here? Like, as you're putting it, I may be young, but I might be very innovative in my approach. So will that be recognized? Will that be defined as value added to the business? So the scheme was quite an interesting one. And as much as they might not be top teachers, will it now just mean that everyone else is no longer going to get anything? Like, someone might not be a top teacher, but they might not just be a bad teacher as well. Because one could say there's a top one, then there's just a good or fair teacher, and then there is a terrible one. Which of maybe the terrible one, you might say, if we lose that, we are not worried, but then what about the others? Are you now saying that there's no scheme for them unless they meet this category of top teachers? So for some of you, it's just imagining saying that we are only giving bonuses in your audit firm if you are a top achiever. And you might then say, but I only got a 4 in my 3rd year or something like that. So does it mean that at these other places I'm not recognized at all, kind of stuff? But it was a very interesting proposal. But let's keep the good and the bad. But you've started giving the good and the bad. We'll come back to them. And yes.
I think my concern, okay, I think on the day I was not present with this task, but right now when I'm reading this, I think my concern is that will the fair value of the phantom shares be equivalent to the 7 years of the 13 check that they have lost? Because if now we are cancelling the 13 check and now they have to wait for 7 years, will the value be equivalent to the total amount that they would have received for that 7 years?
Yes, and this is, and remember that in the pre-release they said that they will aim to make it equal to that. So when they grant the shares, somehow they said they will need to do an assessment to say that will you be better off or sitting in the same kind of position. So they had made a comment on that. The question was probably how are they going to achieve that? Because you remember that they made a comment on the pre-release about that the board will make a determination of the number of shares, but it will likely be equal or above what they will have gotten as a 3rd check.
Yes, I remember.
Yes, so it was a point to consider, because I think one of the things that tends to be discouraging about schemes like this is that they are complex. I mean, I used to just get a 30th check. Now you're telling me I work 3 years and I do this and I do that and I'll get shares, which they may or may not be equal to this. So the complexity could end up disconnecting some of the teachers. So you will then probably need to think about how that will be facilitated.
Rendani.
Hi.
So in answering the benefits and the downside, so I needed to give those benefits from the information that I'm given on the day, because what I'm picking up, what that we are raising, it's coming from this information of the day. Of course, linking it a bit with what we had researched. Am I correct or?
100%. And remember that this is what we have seen SAICA stressed in the previous examiner's report, that responses that really bring your presence on the day get to be considered more favorably. Because there's
not
less
the benefits that I had thought about when I was doing the research.
So if you've thought about it and it's still relevant, so sure enough, it might be worth the credit. But if you've thought about it and now the details given on the day, the point is not fitting so well, it can look as a dumped point or not a well-considered point and could undermine your response.
Yes, because that's what I just noticed now as we discussing.
Okay. Yes, because and I think that there's that assessment that you need to do while you get there to say, after I've gone through this, is my research still on point? And in some cases, you need to be bold enough to say, this I might need to disregard, otherwise I will lead myself astray. But this, there's still a bit of value. Let me see what I was talking about. Oh, this is good. I see that the scheme is clarifying some of the question marks that I had. So now let me address this point because I was worried about this, but I didn't have enough information. Okay.
All right.
Sure.
Sorry, Rendani.
Hi.
Just following up on the question that was asked by one of the previous speakers about the 7 years being taken into account when calculating the fair value. Are we not going to use the 4 years, like 1 divided by 4? Are we going to say 1 divided by 7? Are we going to take the 3 years into consideration? Or are we only taking the 4 years into consideration?
What did you think?
Because I thought we were only taking the 4 years. But then I have a problem with the 3 years. That means the people are going to stay the whole 3 years without any bonuses. Like I'm still not sure.
So are you asking from an accounting perspective or from a benefit perspective?
I'm asking from both perspectives.
So from the cash perspective, it seems that the cash will only flow after 7 years.
Yes.
And then from an accounting perspective, this is now where you could then be saying that you need to serve the company or the school for a period of 3 years. Then these are granted to you. And we will repurchase them after a vesting period of 4 years, meaning that in this case, they are already yours. So this will then be a post-vesting period, these 4 years.
Is it?
That's how I'm reading it. Are you reading it differently? Because it's quite interesting. Because remember that you've been given, because say it says after that period, we will grant the individual. So they will then have them. So that means they've been granted. So they have them. So the only thing that needs to just happen is time has to pass. And it's a passing, it's like I've given you the share options and I'm saying that you can only exercise them after this period. That's a post-vesting condition because you already have them. It's just a matter of accessing them after that period. Because what will be interesting is also that if you give them to me and I work for 2 years and I leave, will I not get anything? Because you've already given them to me and I'm thinking when I leave, I need to give them back to you. will I not get anything if I leave before these 4 years has gotten here?
Yeah, you're not getting anything. But this is a vesting period, Rendani. The 4 years is the vesting period.
Yeah, the terminology, it's it's not as per the accounting standard. From a practical perspective, I understand that payment will happen after 4 years, but from an accounting standard perspective, this seems to have been the period after they vested.
Wow.
So, but let's read. Let's go. Let's read. Maybe we'll change our mind. So where was I? Oh yes, we had identified that this is a group scheme, right? Because the schools, there are schools, remember the structure. There's the parent company, and there are what? The 3 schools. And obviously the teachers are not at the parent company. The teachers are at the schools, which are incorporated, meaning that they are companies. So that's one. Then we realize that there is group scheme considerations. So in the group scheme consideration, what are the key principles? What are the key principles in a group scheme consideration? Whenever you have a group scheme consideration, what are the questions that you need to ask? Tara, yes.
Hi, Rendani. I think there was just something that confused me about the kind of group that Achegos is, right?
Okay.
The fact that Achegos is not a school on its own. It's a sort of a name. And
but it's incorporated, right? That's why they reminded you that it's PTY Ltd.
Which means?
It's an incorporated entity. It's a holding company. It's the parent.
Okay, but now in consolidating, in doing the consolidation, right? Achegos would not have anything, like they don't even have financials on their own. I don't know if I was just overcomplicating it. So I was saying that there are financials for the other schools, 3 schools, but there's nothing under Achegos. Technically, like you won't say assets from Achegos, assets from the 3 schools, and then get the group.
But you might have some equipment for the CEO, group CEO, the Ryan and staff, because they are sitting there at group. So they will need to be somewhere.
So there is something there,
yeah.
But Achegos, not that.
Yeah, but it'll be administrative assets if they are, like your office equipment, your vehicles, probably a small right of use for the rented building and so on.
Okay, that makes sense. So then they will have expenses, just not a school kind of expenses. It'll be like a normal commercial building.
Yes, and depending on how they've structured their operations, to say marketing might be done at company level, where there will then be expenses for marketing services, HR services, which are then provided to the respective schools.
Okay, that makes sense. Thank you.
All right. So now you've got this group scheme. What are the principles before you jump in?
Yeah, Brendan, on the principles, I wanted to say one of the key questions is, are these shares the shares of the subsidiaries, which are the schools, or the shares of the parent? And that becomes important so that at consolidation, we can tell if these can be equities, if this should be considered as equity security or cash security.
Yes, but then the fundamental principles in IFRS 2 deal with what? Because if you check, the fundamental principles don't deal with at consolidation.
Okay, cash security or equity security to determine if it's a liability or equity.
Hey, so they are very specific. What do they ask? What do they ask? What are these specific requirements?
Maybe can I try, Rendani?
Please, Majaji.
Yeah, I think maybe for me, what the question that I will start asking myself is who's receiving, and another one who's settling this these shares.
Yes, so the technical, it's always important at APC. You need to have amassed the right technical knowledge during the 5-day when you go in. And when you've got a group scheme, the most fundamental question is that you need to identify the party receiving the services, where the employees are based. And you need to identify the party settling the scheme. So this is what you need. You cannot deal with a group scheme unless you identify or you respond to this. So who is the party receiving the services? Where are the employees based?
The schools.
The schools. So the schools are the ones receiving the services. And who is settling the scheme?
The parent.
The parent. Then now, this will lead us to the next point. How do we determine whether it's an equity settled scheme or not? How do we determine it? From the school or the party receiving the services, what are the questions that they need to ask themselves to determine whether this is an equity settled scheme or not? Majaji, can you complete that for us, please?
Let me try. For the party that is receiving the services, I think maybe they will ask themselves if they have the obligation to settle this or to settle the cash or to settle this instrument in the near future, maybe paying back the money to the parents.
Have the obligation to settle the scheme, all right? And what is your response? Okay, maybe let's all right, maybe let's continue reading because let's just put the questions down, we'll answer them. So do they have the obligation? What is the other question? If this is not satisfied, what is the other question that they will need to ask? What is the other question?
I think I forgot the other one. Maybe I'll go back to refer to my standard.
All right, where is your research? How does your research look like, guys? Is your research helping you in the assessment? Huh?
Sure, not really for me.
Yeah, even for myself, I didn't think I went back to this.
Why?
Brendani?
Mm-hmm.
I think the second question, hopefully I'm right. Are the awards granted its own equity instruments or not?
Are the awards granted those of the school or not? So this, I'm saying that I'm expecting your research to have question marks too. And to Grace's point, that's where the information on the day will need to help you respond to. Then the party settling the scheme, what do they need to ask?
Are they settling with their own equity shares or with cash?
On equity, instruments, or cash. And then we will need to think about group consideration or consolidation. But these are then the questions that we are parking. So let's read further to see. So Moses is saying, no, my research definitely did not help. Sorry to hear that, Moses. Please confirm if we had to do a simulated calculation. So let's see. So at this point, we have not gotten to the task. So we will see whether the task will require that. Because I was honestly expecting some detailed, some calculations to be reviewed. So at this point, I'm still there and I'm reading to get that sense. Okay, Atara?
Harindan, I just wanted to say that for me, the research.
You muted yourself somehow.
Oh, how did I? Oh, sorry about that. I was saying for me, my research helped halfway. Like it helped with the understanding of everything, but I didn't go a step further to ask myself questions regarding the group. However,
You muted yourself again.
hey, I don't know what's going on with this. Where did I end? Where did you guys hear up
However,
to? Sorry?
However.
Oh, however, my presence on the exam, on the day of the exam, came through for me. So I was present and I was able to come with correct answers.
All right, sounds good. Sounds good. And I think that's always an interesting point, that what if you get there and you find that your research is inadequate? Are you still able to recover? And you should find ways to do so. All right, let's go. So please note that no actual shares will ever be issued to any teacher. So they will not enjoy equity ownership. So now they're starting to answer questions here. Rather, teachers will be entitled to a cash payment upon the repurchase of the phantom shares after the vesting period, based on any appreciation in the value of the equity in the group. These synthetics are therefore share appreciation rights. So in case you are not aware, they've clarified. So just a quick example on how this works. So a share appreciation right, if I give it to you today, we'll need to agree on what we call a reference price. And we can say the reference price on 9 March 20 rand. Then I will then give you, this share expires on 31 December 2022. What it means that you will only benefit if the share price has increased. So if the share price on that day is what, 65 Rand, then the share has appreciated by 15 Rand, which is what? Which is the difference between the what? The two. And therefore, this is the amount that I will pay. Is how a share appreciation right works. So now they're starting to give you a sense to say, when you come back here, you will need to know whether we are paying in cash or in equity. Do you see that? So the moment they say the share appreciation right, they are answering some of those questions. Then they say, for the purpose of the scheme, the value of equity will be deemed to be a multiple of 5 times the consolidated EBITDA. So do you see this? So now if you think about this, what they are saying, because you were asking earlier on, that will it be greater or less than the 5, the status check? And here they've told you the principle of valuation. And what I wanted you to start thinking about is that, do you have any concerns with it? Do you have any concerns with it? The way that they've outlined it, is it better? Or is it better for the employees? Is it presenting risk to the company? Is it even fair? And those are some of the questions that I want you to start thinking about. The synthetic shares in the parent company will be allocated by each school, the separate subsidiary, to their own qualifying teachers. The obligation to settle the repurchase will be that of the parent. The number of the shares to be allocated to the employees will be determined in general each year based on the financial performance of the company in that specific year. This will then be awarded to the employees based on tenure of what services, as well as the employee specific performance rating. Our current thinking is that 50% of this granted will vest based on the average financial performance over the 4-year period, with the remaining 50% vesting based on what? Vesting on the employee's average performance rating over that 4-year period. So to then that earlier question, it is then what? It is then what is the vesting period here? Is the vesting period the 3 years, the 7 years, or the 4 years? Because it seems when you read this right here, there is a requirement for them to then service or perform for the company and achieve financial targets over the 4-year period, and also do what? Also meet the performance rating over the same period. So that is what we have gathered so far. But we are at a point where we are now able to answer questions around the nature of the scheme. So let's go back here. So now, do the schools have the obligation to settle the scheme? Yes or no? Do the schools have the obligation to settle the scheme?
No.
No. Are the awards granted those of the school? Yes or no?
No.
No. So what is then the nature of the scheme? Is it equity or is it cash settled?
Cash.
Huh?
Cash.
Hold on, wait. Is it cash?
Cash settled.
No, let's read paragraph 43B together, right? Does anyone have the standard with them? 43B.
I have it.
Oh.
Okay. It says the entity receiving the goods or services shall measure the goods or services received as an equity settled share-based payment transaction when A, the awards granted are its own equity instruments, or B, the entity has no obligation to settle the share-based payment transaction.
So based on what you've read, what should be our conclusion?
They're cash settled.
Based on what you've read,
But
no.
Wait, guys.
Subparagraph B, then they are equity settled.
Yes.
Yes, what?
The equity.
Has no option.
So are we now agreeing that the nature of this is equity settled?
Yes.
Everybody on the same boat?
Randani, can you please
I on the day.
the paragraph we are reading?
So 43, capital letter B of IFRS 2.
Thanks.
Okay. Was someone?
And so equity settled to who? To the sub or to the group, to the sub, right?
So to the sub.
The entity receiving.
Yes. So to
The entity receiving.
Yes.
Okay.
And
Okay?
it has no obligation to settle the share-based payment transaction.
Yes, and it's an or test, right? Because if it was not, because it says, are the awards granted those of the school or not? So no, they are not of the school. So that means this will normally say that they are cash. But because it's an or test, we move to the second one. Do they then have the obligation? And no, they don't have an obligation. So it's equity settled scheme.
Yeah, it is equity.
All right, cool. Then now we go to the parent. That is now 43C, the entity settling. So maybe quickly, if you can read it for us, please.
The entity settling a share-based payment transaction when another entity in the group receives the goods or services shall recognize the transaction as an equity settled share-based payment transaction only if it is settled in the entity's own equity instruments. Otherwise, the transaction shall be recognized as a cash settled share-based payment transaction.
So based on what you've read, is this an equity or a cash settled scheme?
Equity settled scheme.
So
The cash.
Oh, am I wrong?
It's cash.
Cash.
yeah,
Is it equity?
Why are you guys saying cash?
It's equity because the entity is settling.
Yes, but not with their own shares.
Are we not talking about the parent now?
We're talking about the parent.
We are.
But yes, is using their own shares.
It
Oh,
Maybe
says
Atara-
it's equity
Atara
settled
read.
only if it is settled in the entity's own equity instruments. The entity we're talking about is the parent.
Read the paragraph again and apply.
Are we good? So, because they said that we are not going to give them shares, because they said no shares will be issued, only a cash payment. So there are no equity instruments issued.
okay, with that point, it makes sense.
Then now we go to the group. Because when we got to the task said what? An overview of the proposed what? Accounting implication for the group and the entities of the group. Do you see that? So we have dealt with the entities of the group. Now, how will it be in the group?
Liability.
So let's talk about the nature. Is it a cash or an equity settled?
Cash
It's
settled.
cash.
Cash settled.
Sorry, Rendani, just to confirm, it is cash settled just because these are phantom shares, right?
Yes.
Okay, thank you.
Yes. So you see now, you have now come to have nailed the task. So here, it's just a matter of walking the board through that. And to the earlier question about did we need to do simulated what calculation in the PRI? Doing simulated questions in the PRI, I think it would have been a good idea. Why? Because it will have then helped you to just understand what are the components and what you need to look into. And therefore, you'll then say that it means going into the exam or the assessment, I should be on top of 1, 2, 3. So that will have been what? That will have been a good one. But I will not then, because your next question was, do you recommend that we use for research the standard or descriptive accounting? Because we have not seen an accounting question in the APC that will require detailed technical calculations as we normally see in descriptive. So I will then advise you to shy away from the need to master the calculations, but rather to master the inputs to the calculation. So for instance, if you find that there's a good early examples that will then say, this is why we use 3 years, this is why we use 5 years, that will be a good example because it will then be clarifying how the calculation works. Because I honestly thought that when we got here, Ryan will have just messed up this calculation and will then be ripping that calculation apart. So if I had prepared on that basis, I was then saying I would have known what the fair value was all about, what the vesting period was all about, and so on and so on. Makes sense? Is it any? That's what it says. It just says any guest.
I have a question, Brendani. Can I please ask a question?
Go for it.
Yeah, so that part for accounting implication for the group and the entity. So now when answering it, do I go back to the steps? You see the steps that we were doing now?
Yeah.
Because I think the mistake that I made, I sort of like went through the steps, but when I get to the implication, I just said it will be measured as, like, for instance, cash settlement without perhaps like splitting to say, okay, what's the vesting period and all of those steps that we're going through.
Yeah, because here it's so now we will have to talk about this. So now when we say the accounting implication, what do we mean? What do we mean? So remember that we've got quite a lot of information here, which for 2 slides, one, it seems a bit generic. In some cases like this, very generic. And then we've got something that is more specific. So when a question then asks you, give me the accounting implications, what do you want to do? What do you want to do? So we're gonna quickly get to that, but let's now go to the rest of the facts. Then they say that the shares will then be issued in respect of the average financial performance over the 4-year period. The 4-year vesting period will vest on a sliding scale in relation to the average annual thing. So to is it Annelise's earlier question? This was quite interesting because firstly, they told us that this will vest, or after that period will grant these individuals these phantom shares. And now they are telling us that these shares will then be vesting on a sliding scale. So the question here, they will be issued in respect of the average performance. So it got me a bit confused here to say, then when are you issuing them? Because now you are now telling me you're issuing them in respect of the average financial performance over the 4-year period. But I thought you were just issuing them after the 3-year period. And they will then be vesting over this 4-year period. So this, for me, was a bit confusing. But when I looked at the overall scheme of things, I would have then avoided making probably then a committing or a committed decision. And I would then have been able to still demonstrate to the board that this is how it works, but without necessarily dwelling on my confusion of the 4, 7, or 3 as the appropriate accounting vesting period. Does that make sense? Because the last thing I want for it to happen is for you to lose or to fail to demonstrate competence because of one issue that in the bigger scheme of things was not that critical. Because, I mean, we have already done quite a lot here. So the fact that you are struggling to resolve, make a call. Be saying that you've taken the position that this will then be vesting away for a period. So your discussion, even better, because they don't want numbers, you don't need to be dwelling over whether it's 4 or is it 7. Does that make sense? Because I don't want you to find yourself stuck and then saying that this question didn't go well for me because I did not do this and that correctly. Okay. Any questions? Yeah, this one question. Please go for it.
Rendani, for me, the way I understood this, I think somebody mentioned it earlier.
Yes.
What I understood was that the existing teachers were going to get a head start. So they were going to, because they already had the 3 years services, they were just going to be able to apply for the 4-year vesting period situation. But they knew teachers would need to wait for 7 years because they wouldn't be having the 3 years, so they would need to start from scratch. Yeah, that's how I understood it.
Yeah, and I'm hearing you, but based on what?
Sorry, you cut a little bit there.
I was saying you are getting to that view based on what?
I'm getting to that view based on the fact that if they're saying you need to first service for 3 years, if I've been in the company for 7 years, back to your example, then the 3 years is already covered. So I'm right now today able to apply for this scheme right now, right? But if I'm a new teacher that just started, I must first finish 3 years and then I'll be eligible to apply for this scheme. Yeah, so that was the take I took.
Yeah, I thought it was just a complicated scheme. Like, at what point are you a top teacher? In the 3rd year? What if I become a top teacher in the 4th year?
Yeah.
What will happen? Because it says we identify top teachers based on experience. And the first 3 years I'm struggling or I'm slacking.
Yeah.
Then I start being a top teacher in year 4. Do I now get credited for the 3 and now just go into the 4th? What if I become a top teacher in year 5?
If you become a top teacher in year 5, then you would have to have 2 years. You would have to, like, the first year of you becoming a top teacher wouldn't be counted. So you would only be eligible at year 5. Hi, Randy, you were just thinking too much about this thing.
Maybe we are complicating it. Like I thought the detail was complicated. I will not have been okay after sitting for this. I thought the details were just a bit cryptic for me.
Okay, yeah, I agree with you.
Sorry if I may just jump in to answer the question from where I see it.
Sure.
If you go to the next page, it's got a sliding scale relating to the performance. The second table, I think, to answer the question about where do you become a performing or a top performing teacher, if you are below 3.5, you are not top performing according to them, and therefore nothing vests to you, which means you are not entitled to participate in the scheme, or you participate at 0, so to say. So in my view, if you become top performing in year 3 or wherever you are, that means to say you have exceeded 3.5 and you begin to participate at 50%, and you can fluctuate during that period. And I should put a disclaimer to say, in my view, or from what I know, these kind of calculations will actually not even be done by the accountants in terms of the fair value. It would be an actuarial, mathematical, very deep mathematical calculation, which would look at all these things and include them. But I'm just trying to answer to say top performing is not just like a thumbs up thing where we wake up and say this teacher for this year now is the top performer. We have to look at his ratings and say he is now sitting at 4.2, and therefore he is now a top performer with 75% participation. That's just my view there.
Yes, yes. And I think maybe you are missing me because I'm saying that this is based on the 4-year period. So now, if in years 0, 1, 2, 3, 4, I was clearly here. So that means, will I enter even this 4-year period?
Oh, I get you.
Or do I start entering it when I have demonstrated that I'm top performing because I'm above 3.5, and now please start counting my 4?
Oh, yeah.
Yes.
No, I get you.
Yes, yes. Yeah, and I get where you're coming from. So it was just those details, but I was like, maybe for me to respond to the task, I will then just put it and say that from a downside, this sounds like a complicated scheme, and it could result in a negative morale or a perception that the company is not looking to award the teachers. So,
Yeah.
so I will raise it as a concern because, I mean, this thing is so complex. I mean, imagine us here, we are, and we are prospective chartered accountants. We are struggling to make sense of it. Now you introduce it in this form. You are then saying what? You are then saying that will people not think you are being funny with them?
Yeah.
Yeah.
Okay, I was about to continue with the complexity. I was saying I agree with the fact that this was very complex. And yeah, I just have to shine a little bit here, guys. I did get a C for this task. But here's what it took. I took up a full page at the back of my question, my tasks. I have a full page where I'm breaking down this thing, like for my understanding. So I think I might have also spent also spent too much time on it.
And that's the thing that and that's what I was saying, that don't dwell and find that whatever you're dwelling on is not so significant in the bigger scheme of things.
No, I agree. And the other thing that I'm noticing though, Rendani, about this question, the way you are taking it, you are on the side of the teachers, not on the side of management. So this is where we are differing, because you are concerned about, no, this is so complicated. No, this is yeah, why should I work for 7 years before I get my bonus? Why must I wait? But you are on the side of the employees. Like, I think this is my opinion, that I think you are coming from the employee side. You are thinking as an investor or as an employee, and I was thinking as the management. You know, I was thinking as our. That's why I think most of my answers were based on what we are trying to do, which is trying to retain employees and also get new attract new top employees. I'm not sure if I'm correct.
No, I'm clear. I'm clear. I'm clear where you are, where what you're saying. All right, thank you for that. So
and
now,
just to ask a question,
yeah,
to Atara, if the objective is to attract and retain top performing teachers, how is it not detrimental to the company if eventually the results do not attract and do not retain? Because I'm trying to defend the approach or direction that Renan is taking, to say, if whatever this thing results in does not attract and retain, or is viewed as negative from the teacher side of things, then it has not achieved the objective, and therefore the company itself does lose. Just thinking from that direction as well.
Okay, I like your question. you make a good point in that and ultimately whatever the decision the management makes must come back to retaining and also attracting new employees. But again, I see where you're coming from. It's just that I also thought we are broke. We don't have money currently to be paying a scheme. So something is better than nothing, because now we were faced with a situation where we were supposed to not have a scheme, to not have a performance bonus at all. Yeah.
Okay. Thank you for that.
Thank you. So here we are. So let's just probably see how one could have what approach this. Because when we got to the task, after going through that kind of thinking, they said your draft presentation should consist of approximately 4 slides covering the following: the potential benefits and downsides of the proposed scheme for the what? For the company and its shareholders. So they say 2 slides. In my view, or in my plan, I will have then had slide 1 just dealing with the benefits and slide 2 dealing with the benefit, with the downsides. Did you guys approach it differently? I'm just keen in terms of when they say 2 slides, whether you looked at it in a different way. Where we aligned here?
I looked at it in the same way.
Okay. And I think a lot of the points we have touched on, the benefits are clearly there of the scheme. And I think the biggest one, it is that one, you have what? You have that cash benefit because you don't need to worry about dealing with the payments immediately. And this scheme, because you are allowing participation in the value of the company, this could create better alignment between the interest. That's one of the things that we mentioned when we talk about the incentive, is that goal congruency. So now if you tell me that this is where the company wants to be, and this is what we want you to achieve, I mean, this scheme right here has now introduced EBITDA, and EBITDA is beneficial to the shareholders. So there is now better alignment between interest of what? Of shareholders and the teachers. And the fact that, yeah.
Sorry, I have a question. In the benefits and downside, was there a need for me to split it for articles and their shareholders, or did I not read the statement correct?
So it's an interesting one. So are you saying that when you are dealing with the slide, you want to then say the benefits for A and the benefits for shareholders?
Yeah,
is that what you're suggesting?
That's what I did.
It's an interesting one. I don't think in itself, based on what to read, it could then have been something that one will be too fixated on. I would just have thought that it didn't make the question difficult for you, because I'm thinking that it will take me a few more seconds to pause and think that this is a benefit for the shareholder and this is just a benefit for the company.
I guess maybe that's the reason why I took more time, because I had to really sit down and try to.
Yes.
So there wasn't a need for that.
To be honest, I will not have gone that far. I will not have gone.
Why not? When the statement is clear?
Because when some of the benefits, for instance, right, like this one of talking about better alignment, So if then the teachers are incentivized to increase EBITDA, it is good for the company because the company's performance has increased. But because the company belongs to the shareholders, it is also good for the shareholders. Do you see that? So in that instance, you could have then come to me and said that this is a benefit for shareholder, and you will not be wrong. And I could say this is a benefit for the company, and I will not be wrong. Do you understand? So there will be very limited considerations that will be for the shareholder and not for the company. You see, and that's why I'm saying that that approach will have then rather slowed me down to say that I need to then think about that carefully. Because now if I ask you, and let's just talk about this obvious one, the cash benefit. Do you think it is a benefit to the shareholders or to the company?
I think both.
Do you see that? Because now one, if the company has got cash, it can declare dividends to the shareholders. That's good for the shareholders. But then if the company does not have to pay the 13th check, then it is a benefit to the company because its liquidity position has improved.
Yeah, and I think somehow I also struggled to then bring in the benefits for the employees. Like I was struggling, where do I put it? And yeah,
and because then for me, when I think about the employees are for the company. So when they are benefiting, that means the morale is up, that means they're incentivized, and they will then work harder. So there could be increased productivity, which is for the benefit of the company.
Yeah, no, I think it was a matter of English and interpreting it. I don't know.
Yeah, but I hear where you're coming from. And as I'm saying that it is not wrong per se, it just required an extra layer of thinking.
All right, thanks.
Yeah, I see Courage is saying that also he took an approach to say slide 1, let it be benefits and downside for the company, and then slide 2, benefits and downside for the shareholders. Okay, interesting. So maybe then while we are here, Courage, maybe you can give us an example of where you felt that this is a key consideration to the shareholder and not for the company and vice versa. I just want to see how someone could have thought about it, because I will then share one of mine, which I thought that this was clearly a shareholder consideration. But maybe Courage, you can share just one where you said that this was clearly a company's consideration and this was clearly a shareholder's consideration. I just want to hear your view. Yeah.
Hi, Rendan.
Good evening. Yes.
Good evening. So mine, I think it's just a matter of interpreting the facts that are here. So that's how I just interpreted it. Then drilling down to say what are then the considerations for for the shareholders. But I was just analyzing from the face value to say, what does this statement want me to do in terms of my breakdown as I'm planning my responses?
Okay.
Rendan?
Yes.
Before you bring your benefit to the investor, just want to try this one. Maybe it could be the one, or it could be one of them. The EBITDA times 5 sounds to be very low. You are pitching a share price at very low amount. EBITDA maybe are up to about 10, right? I don't know, maybe for this industry, but if it's very low, that means to say the employees are getting a low value out of this, even the cash benefit, which will be beneficial to the shareholder. And I still can use that as a downside to say it can demotivate the employees, 100%. Or it can give very little impact. Then it can be downside for the company.
Yes. So every good point. where something, and that's where now there's this conflict that shareholders will want the company to give as little as possible on the table to the employees, but get out as much as possible from them. So that the what you just said now, it's a very good example where there's that difference between the two. So good point, yes. Okay, Gracious. We need to wrap it up, yeah.
Yes, just to follow up on that question, like I'm trying to get myself to the level of how you're thinking, you know, maybe some of the reason why some of us didn't make it is having that thinking to say, is it reasonable for me to break this thing down? So what made you to just say that, okay, this is how I'm going to address my benefits. I'm not gonna split.
Yeah, so it's a very interesting question you are raising, to be honest. And I think it is just a matter of the overall task impression. And I'm sure you might have seen it when also Kum was approaching the task A, that when you stop and think that, what am I trying to do here? I'm trying to demonstrate to the board that this is a good thing, this is a good thing or not a good thing. And that is what's just mean to say that I'm contributing to answering that question for the board. Is that good or is that bad? And then I'm thinking that the board's responsibility, it is both to the shareholders and to the company. So when something is good, so yes, they will then consider it as good, and maybe the final deliberations, it will then be them seeing that the shareholders are putting us under pressure. We need to prioritize them, but they will need to just have the entire lot to say, these are the good thing about the scheme and not so much good things about the scheme. In terms of which ones they prioritize, I'm thinking that's a problem bigger than me, and therefore bigger than my concern, and therefore I should just do this. But that's why I'm saying that if you had approached it that way, I will not have penalized you because you were not wrong. I was just saying that it probably then was a bit demanding going through the response. So I don't think that it will have then been a matter of, if a candidate did it this way, then this candidate is not competent. It will just be that extra layer of thinking.
Oh yes, thanks. No, yeah. I get you.
All right.
Hi, Rendani.
Yes, Kazi.
So on the point of that Gracious is making, like, reading the question, I think didn't they ask us to present 4 slides in total? And then if you check for accounting for the group and for the subsidiary, it's 2 slides on its own. And the downside and the benefit is 2 slides on its own. So we split it into shareholders and then Akego separately. That will give us almost like total of maybe 6 or 8 slides already.
So Kazim, what I did is that I had some, okay, so it was slides, ne? So I had some, what do we call those pointers, sort of like explaining some of the
speaker notes.
Yes, speaker notes. So I don't know if that was correct or not, just to answer your question.
I'm just thinking because I was like, I also tried to limit it to two, which is downside, and I just mentioned the whole thing in one side there. So, and then that could also make me not covering both the shareholders and the Akegos completely. Should I have separated the way you said, trying to separate it on your side? So I think both points also have the benefit and the downside as you splitting it one by one. But what I was worried about in the exam was like not making more than 4 slides as they required.
Yeah, that's don't do that. Don't do that. Yeah, don't do that. So that will be a problem if you go more than 4.
Okay, thanks.
All right, let's wrap it up because yeah, it's much later than we should. 3 minutes after. So quickly. So I think here we are aligned in terms of what? In terms of the approach. I think another thing that you will have needed to decide on is how many points per slide. And it's always quite interesting. I think for me, I and again, it will have just been me. I will have then been targeting like 4 points for each slide. And 4 will give me a good feeling more than anything, because I'm thinking that still this is the board. So they just want the highlights. They will probably deliberate more on one point over the other. But if I give them 4 strong points for good, 4 strong points for negative, I will be proud to move on. Then when it comes to the accounting implications, again, it's a matter of how do you deal with it. So I will have then split it in terms of initial recognition and subsequent measurement, where I'll then say the board, from a classification perspective, the schools, it will be this. For the company, it will be this. For the group, it will be this. And then we will need to do it. There will not necessarily be any journals at the beginning, because on initial recognition for a scheme, you don't do anything. But then measurement, that's where then the focus will be. How do I determine the balances to say that we will then consider the conditions attached in determining the balances and the expectation of the number of employees that will be there. But when I get to slide number 4, I'll be just making them understand how this will then be, how will the impact be on the financials, to say that we will have an impact on P&L, and the impact will be the difference between the balances. Factors affecting the balance will be these conditions that we've put, and the expected number of employees that will be expected to meet this. Because now, if I leave the board there, I'm thinking that they will be able to think better to say, hey, no, this is too low, this is too high, and so on and so on. So I just want them to understand how to then get to the measuring of the liability going forward, and the impact that it will have on P&L and the statement of financial position. So that will then have been my 4 slides. Are we good to leave it there?
Happy.
Thank you very much.
One last question, Rendani. So on the accounting implication, right?
Mm-hmm.
Okay, so we're writing to the board.
Yeah.
Wasn't there a need for you to explain some of the things? Because I mean, I'm going back to the speaker notes.
Yeah.
We're limiting the slides to 4, but would it be sufficient if you just do the slides, taking into account that I mean, the board is comprised of different types of people?
Yeah, because here they gave us guidance. So remember, the majority of the boards do not have specific background in accounting. So I would have shied away from referring to things as vesting conditions and so on. I would have just said the requirements we put to the employees. Do you understand? That the employees are required to do this, and this will be considered in determining this. So I will be talking to the technical accounting, but I will not be introducing the terms.
Or in simpler terms.
Yes, so I will then say that essentially the employees are required to fulfill this in order for them to get the shares. So I'm essentially describing what is a vesting condition. Do Do you understand?
Mm.
So it's not like next time when someone comes and say the vesting condition, they ask what is the vesting condition, then if then the person clarifies, they'll say, oh, yes, Gracious told us about that, so we are with you now. Please continue.
Okay.
Yes, but if you've been to some of these board meetings, you really don't want to introduce this terminology because you will get stuck. Like on slide 1, you put vesting, and then a doctor will be asking what is a vesting condition, and then an engineer will be coming there, so it can get messy. So the simpler you go, but without losing the underlying technicality, is how you should approach it.
Okay, thank you.
Are speaker notes necessary? Rendani, I heard Gracious mentioning them. Are they necessary? I've got a feeling that they may tempt you to write more and try to dig deeper, and maybe they don't even get marked. I don't know.
In this case, they were not specifically required. It was interesting. In previous APC, we've seen them being required. Here, they were not. So Gracious was really gracious with this task.
So can we then conclude that if it's not mentioned or it will be driven by the audience? I don't know, Rendani. I've seen speaker notes somewhere. Yes.
Yeah, so in this case, because it was not specifically required, I will not have done this.
Hi, Rendani.
Hi.
But
Pamela say, let me sit here and it is here. Don't say that, Pamela. Yes, sorry, Tara.
Okay. You can't miss that, Pamela. I agree. We are APC now. But I wanted to say, Rendani, oh gosh, I lost my train of thought. Rendani, what was the last thing you said? Please remember.
Speaker notes. You're talking about speaker notes.
Oh, speaker notes. Yes, I was saying that it would be very difficult to put the full detail on a slide without having too much information. So don't you think we would have been penalized if we just wrote like put down everything we are thinking of on the slide without an explanation?
But will it hold in court to say, if your manager says, please send me slides, and you do slides and you send them to them and you don't explain them or outline the thought process in the speaker notes, will you not have done the task?
I would have done the task. I think I'm asking from a point of view of a slide is supposed to be point form and short.
Yes.
Right? But in order for me to explain everything I wanted to explain, I know myself personally, I would have used many words. So I'm saying now, if I've used so many words in one slide, like a slide is looking like a full page or paragraph, like, wouldn't I be penalized for having slides that have sentences inside? I don't know.
Yeah, it might count against you. And it was quite interesting to say what was the expectation here, because like the process we went through of whether this equity settlement scheme, did you expect the candidates to just put that answer and move on, or at least they should have somewhat said that for the parent, this is an equity settlement scheme because sometimes slides are point form, but they could have some explanation in them. It's not unheard of, as long as it's not now a full sentence, but it could be just hitting the core.
But now, based on previous accounting tasks that we've had, they normally want to know why.
Yes.
So I think it was a bit challenging to know where to put the why, because then it means the slide will be full.
I agree. I would have said that anyone who had done speaker notes, that's an HC. I mean, remember HC is value enhancing. You have added value to me. I didn't ask for them, but now you've helped me not to come back and say, I saw you said this is I saw you said this equity. I don't need to ask you. You've given me speaker notes. So if it was in the real world, I would have said that you are a top candidate. As much as I've not asked you for that, you gave it to me.
Okay, that makes sense.
Okay. T.
Oh yeah, that's me. Sorry, I just wanted to ask. I think it was Atara that said she got a C on that. On your response, did you just address only these slides? Is there anything extra that you added, maybe on the board of the email?
Yeah, good question, actually, yes.
Was that this everything that you addressed, only the required there on the slides, potential benefits and funding implication?
Good question.
Okay, if I remember correctly, I really just answered what was asked, but I think I had speaker notes just explaining like where I was coming from.
Interesting.
Especially for the technical part.
Okay.
Yeah, so I wanted to pose this question to Rendan because I kind of waste my time trying to, during the research, I wasn't sure if it was permissible for a private company to issue these share-based payments. Can you maybe just clarify that, because I couldn't figure out the legality from Companies Act perspective?
So unless maybe I'm not very clued up on it, I don't think there is essentially a problem as long as it's properly authorized by the shareholders. But I think this will also be outside the shareholders' ambit because there are not actual shares being issued. It's cash just linked to the share price. But if it was an actual share options or shares, I know the shareholders will have needed to approve this. So I don't know whether there are any specific approval requirements for a share-based scheme. But I don't, on top of my head, I'm not aware for this kind of scheme where it's cash just linked to the share price. So I'm not aware of that. I can ask Kumu and Fadi, I think they might be closer to the Companies Act, but it's a worthwhile question.
Yeah, because during my research, I think there was section 95 that was talking about offer to the public. So, and I think section 95 of the Companies Act then is linked to 97. I think maybe that's why I fell, because I put that in the board of my email to say like before, because I didn't know how this whole thing started. So I thought because it's not a listed entity, like they cannot offer shares to the public, or unless if they are exempt to be offered to the public in terms of section 97. So that section 97 has got its conditions to say for a scheme to qualify as a share incentive scheme, it has to meet certain criteria, like they must appoint an officer and all, but I didn't go in detail. But because during the pre-release, I wasn't really sure if that's possible to issue shares for a PTY, to issue shares to the public, because the Companies Act prohibit any PTY limited to issue securities. So securities include shares or debt and all these kinds of stuff.
Yeah, so I will lie, but I think just my question will also just be around will be around the fact that there were no actual shares here, but rather share-based payments. But as I'm saying, I think someone closer to the Companies Act will have then be a good partner in my group so that they can raise this issue and maybe provide more guidance.
Yeah, your thinking is correct here, Rendani.
So, but sure. All right, let me not keep you too long. I see you guys don't want to leave. But no, thank you very much for the engagement. So very interesting thoughts on the task. Yeah, so all the best with it. And just on the last point, T, for me, it was also something that I could have raised as well about the fact that the company is not listed, and just the determination of the value. But I think it came through when someone spoke about that 5 times consolidation, because the fact that it's not listed is got those ethical kind of concern on how the price was being determined. But I think someone raised it well as well. All right, but let's keep it there. Thank you very much for your engagements and for your patience. So have a good evening and all the best. But if you still have any queries, then just drop them via WhatsApp. Then I'll assist accordingly. Thank you.
Thank you, Randani.
Have a good night.
Thank you. Good night.